Okay. Matthew, you're up.
All right. Well, good morning, guys. Hope everybody is well this beautiful Wednesday morning. I wanted to talk to you really quickly about a couple of scenarios. Yesterday, I was driving back from the coast. I work all over North Carolina, South Carolina, and Virginia. I was driving back from the coast late last night. Late, when I say in the insurance world, 7, 8 p.m. is late. And I got a call from Leah. Leah had a situation where her client, she had referred her to us, but the client never gave us a call. And so the CD displayed an insurance premium of $1,975, almost $2,000 a year. And Leah said, whoa, wait. I referred you to Matthew. Did you not call him? Well, no, I got 5 quotes, and consumers think insurance is all the same. So she said, you know what? Leah, the agent, said, you know what? We just sit tight. So she reached out to me and said, Matthew, this home is older, but it's in good condition. Does that sound reasonable? I said, it does not. It shouldn't be almost $2,000 a year. And guys, that was the best quote she got. So about 8 o'clock, my team turned around a quote for Leah for $890. So for those of you doing the math in your head, we saved that client almost $1,000, or rather Leah saved her client $1,000 via us. How many of your clients are Leah's clients, where you say, hey, call Matthew, our insurance guy, but yet they went online, got some astronomical quote, or call 800 numbers, or go to other offices and got a quote for literally $1,000 more? And we're not going to talk about upgrades in service and coverage and so forth. That's a sidebar issue. So not to be outdone, a few minutes later, I got a call from an agent. We had written the client's homeowner policy, and the client wanted to move in one day prior for closing, but they just hammered this arrangement out about 7 p.m. or 8 p.m. last night. So there's one little hiccup. In order for the client to move in a day early before closing, and we'd already written their homeowner's policy, the seller was requiring renter's insurance. So around 8:30 p.m., my team gets her a policy written for her client, and they needed it at 9 a.m. today. Anybody want to guess yes or no if the client got to move in? The answer is an emphatic yes, because my team's available 7 days a week until 10 o'clock every day of the year. Guys, that's what makes us different. That's why when you have clients, rather than being like Leah and saying, here's Matthew's card, if all else fails, guys, use us as an offensive position up front, prematurely, proactively, because Leah had to spend her evening fixing the insurance situation that she could have avoided had she just group texted me and the client, or even had texted me and asked me to reach out to the client. So guys, hopefully you guys will heed that experience that Leah had and save your time from having to chase after insurance after the fact. So guys, as always, I'm here again 7 days a week, every day, to be a source for you, questions, issues you guys have, of course, referrals. But again, rather than just waiting for the client to call me, which many times they drag their feet if they ever do call at all, let us reach out, just like you do with your mortgage partners. Let us reach out to them. So guys, that's today's little update. Roof age over 20 years of age is a problem. You probably want to reach out to me on a case-by-case basis. So if nothing else, guys, I'll put my information in chat as always, and hand off to Rudy and let you guys continue on. So thanks so much, and look forward to seeing you soon.
Thank you, Matthew.
That's service, Matthew, for sure. I'm going to share my screen, Melissa. I'm not sure what's going to come up here, so just let me know once you kind of see it.
Okay. Yep, looks like yeah, it says PowerPoint, or excuse me, it says Fairway Mortgage. Looks like a PowerPoint.
I'm going to switch it to slideshow, and hopefully you'll just see the one slide there. Are we good?
Yes.
Okay, very good. All right. Well, I appreciate the opportunity to be here. It's been a long time. I think the last time I was at Lantern was probably 3 years ago with Terry Whitesell, and we did a little training session, and it's glad to be back with you, even though it is virtually. Some of you I have met. Some of you have probably been in some classes that I've done. So for you, this will probably just be a review, but some of you probably, this may be the first time that you've ever heard of reverse mortgage as it applies to your real estate business. So, you know, just know we're going to go through this quickly today. It's going to be an overview. Anybody that would like to have a one-on-one to talk a little bit more in detail about this, ask questions and all of that, I mean, I'm willing to meet with you anytime. Just let me know. Coffee's on me. I think Melissa is going to be monitoring the chat. So if you have any specific questions, just type them into the chat box. If you are in front of a computer, or if you're not, just feel free to chime in and ask your question while it's on your mind, because odds are somebody else may have that same question. So let's kind of look at this from the standpoint. I know for some of you that may not be never really looked at or considered reverse mortgages, you may be thinking, well, why in the world is this even important to me? Why should I even know anything about it? I mean, aren't reverse mortgages for older people that just want to age in place and stay in their house and never want to leave? And that doesn't help me in my business at all. You know, some of that is true, but actually, today's baby boomers, of which I am one, I mean, they are on the move. As a matter of fact, according to an NAR study that was done back in 2019, almost 40% of purchases, and that's new construction and existing homes, were actually done by boomers. And based on surveys, about 3 out of every 10 baby boomers today do have plans to move. And in many cases, that means potentially a listing and sale or both. For you, and North Carolina is a hotspot. So there's a lot of reasons to basically be in tune with some things that could be beneficial and helpful when you're working with those older buyers and sellers. I also think just having knowledge as a realtor in the business you're in makes you a better realtor. I was in real estate, was a real estate broker in West Virginia back in the 80s. A long time ago when interest rates were double digits, and wasn't the best time to be doing it, both in the state and I was in and the market I was in. But, you know, at that point in time, everything was pretty much price driven and transactional. It was, you know, how much is it? You know, just turning homes. And, you know, there's some of that obviously in your business today, and you know your business better than I do. So I'm not here to lecture you on that, but I do think that to be competitive and be good in today's market, you really need to bring value and some strategic options to your buyers and sellers. And this is one, I think a reverse mortgage fits into this, and hopefully you'll see that as we go along. I think it is an opportunity or a way that could potentially increase sales and listings for you. When I started with Fairway doing this about a little over 4 years ago, I mean, at that particular time, the biggest challenge that I had was just trying to get past some of the myths and misconceptions that people had, just ideas of what they thought a reverse mortgage was. And quite frankly, that's the same challenge I have today. There's a lot of people out there that when they hear reverse mortgage and what they think is, you know, that's a scam. Don't do that, because in the end, the lender ends up with title to your house. You'll end up owing more than the house is worth in the end, and they're either going to stick you or your kids with a big debt. On and on and on. None of that is true. And I think this saying from Mark Twain probably about sums up the challenge that I see daily with that, in that it ain't what we don't know that gets us in trouble. It's what we think we know for sure that just ain't so. And I suspect there's probably some things that you think about a reverse mortgage to be true that just aren't so. So we're going to jump in and kind of go through some basics of what they are, who's eligible, how it works. But I want to take some time at the end to look through some real life examples in your world where this could be applicable. Hopefully everything, the pieces will come together. Okay. The most common reverse mortgage out there today is the FHA insured reverse mortgage, which is known as a home equity conversion mortgage. This has been out there and available in the marketplace since the mid 1980s. It has undergone a lot of changes from a regulatory standpoint over the past 10 years. So it's kind of like, you know, it's not your father's Oldsmobile today. You know, the product today is much, much different. It is FHA insured, as I mentioned. It is a HUD regulated product. It is a non-recourse loan, and that's important, and we'll get a little bit more into that later. It is designed specifically for older homeowners and home buyers to give them a vehicle that will allow them to convert home equity into cash in various forms without negatively impacting cash flow and liquidity and that type of thing. You have to be age 62 or older to qualify for a reverse mortgage. Now, if it's a couple or you have borrowers where one is 62 or better and the other is not, you can go forward with a reverse mortgage. It's just that non-age 62 owner would be considered a non-borrowing spouse or a non-borrower per se. So they won't be on the loan. And upon the death of the actual borrower, they would be able to continue to live in the house under the loan, but they wouldn't have access to any additional equity to convert to cash through the loan. And there's some ramifications there and some more details that we can talk about at another time. But you have to be 62 or older. It is FHA insured, so the property has to be an FHA eligible home, and it has to be the primary residence, meaning the place that the borrower lives at least 6 months and 1 day a year. How much you can borrow using a reverse mortgage is really determined by three things. What's the house worth? What is the age of the youngest borrower? And what is the interest rate either at the time of the application or the time of closing? Now, just a good general rule of thumb, if you're thinking about this for a buyer or seller, is take the age of the youngest borrower, subtract 20, and that will give you a pretty good estimate of how much net loan proceeds that borrower would have available to apply toward the purchase of a home. For example, a 65-year-old would be able to borrow after closing costs, have roughly 45% to apply to the purchase price, and would need a 55% down payment. The thing that makes this particular financing option, I think, much more sensible for an older borrower or retiree is the fact that it has no required monthly mortgage payment. Now, you can make a payment as little as you want or as much as you want when you want. There's no prepayment penalties, but there is no required monthly principal and interest payments. The only requirements to keep the loan in force is that the borrowers have to occupy the home as their primary residence. They have to maintain it, including paying HOA fees. They have to pay their homeowner's insurance. They have to pay their real estate taxes. Okay. Any questions come up so far, Melissa?
No.
Take that as a no.
No.
Okay. This is a mortgage. You boil it down to its simplest form. It's a mortgage. So it's a loan secured by a deed of trust against the borrower's primary residence. They remain on the title. They do not have to come off title. They can sell the house anytime they want to, pay off the loan, go buy another house with a reverse mortgage if they want to. Because there is no payment, the credit qualifications to qualify for the loan are different than they are with a typical mortgage. No payment means there's no debt to income qualifications. I'm sure some of you have run into situations where you've had buyers that had difficulty qualifying because maybe they were retired on fixed income, had plenty of assets, but didn't meet the DTI percentage we needed for the particular loan. These basically use a residual income financial assessment test very similar to a VA loan. So we just look at their gross monthly income, subtract any obligations they have to existing loans, excluding any mortgage, and add in the estimated monthly taxes, insurance, HOA fees, and they need to meet a residual income requirement. Typically, they're borrowing anywhere from 35 to 75% of the value of the home. Again, the older they are, the higher the percentage of the value of the home they can borrow. The lower the interest rates, the higher the percentage of the value of the home that they can borrow. So right now we're in the lowest interest rate environment in the HECM world, just like we are in the traditional mortgage world. So percentages are considerably higher than they have been in the past in terms of equity that can be accessed through the loan. It's loan proceeds, so any monies that they get is not considered income. Generally, doesn't have any impact on Social Security, any Medicare benefits, and that type of thing. The loan is not required to be repaid until either the owners and borrowers decide to sell the house, obviously, which we said they can do anytime they want to. When they do, the loan balance obviously has to be paid off to release the deed of trust to convey free and clear title to them. It also would become due and payable when the last surviving borrower no longer occupies the home, meaning they've either left the home to go to a nursing home or assisted living facility or have passed away. If should that happen, the heirs inherit the house. They can buy the house if they want to, simply pay off the loan balance. They can sell it, pay off the loan balance, pocket the proceeds. They can, whatever they want to do. They inherit it subject to the mortgage just like they would with any other mortgage loan. Okay. There's no real term, since there's no mortgage payment per se. There's no specific term for this particular product, but it's interesting. The note that's signed at closing actually shows that the loan is due the day that the youngest borrower reaches age 150. Now, to my knowledge, that has never happened. And I've asked a couple of times, well, what would happen at that particular point in time? And I think basically what I've got is shrugged shoulders, really not sure. But maybe we'll see that happen one day. People are living longer, of course. We mentioned non-recourse earlier, and this is the real value of the FHA insured component of this loan. It's the FHA insurance that makes this loan non-recourse. Anybody want to chime in as far as what they understand non-recourse to mean? Anybody? Even in the chat box? It basically means that the individual borrowers are not liable for that loan. It's the collateral that's pledged as security for that loan is responsible to pay that off. So the FHA insurance guarantees that the borrower nor their heirs will ever owe more than the house is worth. Now, this product has been fine-tuned over the years, and the likelihood of anybody ever owing more than what the house is worth today is considerably far more remote than it would have been in loans in the past. But that's critical to the loan, and that's one of the primary reasons for the FHA insurance. It protects the lender in that the lender is never going to lose money either, but it also protects those borrowers. And of course, we mentioned, and this is what you're most interested in, is you can purchase a home with a reverse mortgage. And that's been true since 2009. But it's amazing how few people I talk with that really understand that and know that to be the case. So there's basically three ways you can convert equity into cash using reverse mortgage. You can get it lump sum. You can take equity and convert it into an income stream on a monthly basis if you want to. There's a line of credit involved in it. Basically, with a purchase, you're looking at a lump sum distribution. You go to closing. Most people in a purchase will access the maximum amount of loan to allow them to bring the minimum down payment, including the closing costs, and that's a lump sum disbursement at closing. Now, I mentioned earlier that you can make voluntary payments if you choose to, and the interesting thing with the reverse mortgage is anytime you make a voluntary payment, you lower your loan balance, you create equity, and that additional equity that you just created is now available to you as the borrower going forward in a line of credit. That line of credit, it works very similar to a home equity line of credit, except it has two very distinct differences. One, it cannot be canceled as long as the borrower lives in the house, pays their taxes, pay their insurance. That line of credit cannot be canceled by the lender. The other thing is the line of credit is guaranteed to grow. The line of credit will increase at the exact same rate as the loan interest rate plus 0.5%. So you can use a reverse mortgage just like you would a traditional mortgage, make payments if your cash flow is such that you can do it, and just know that, hey, I'm lowering my loan balance, I'm creating equity just like I do in a traditional mortgage. But hey, guess what? If I have an unplanned expense come up, a medical expense or a home repair or whatever, that equity that I've created is available to me in a line of credit that I can access tax-free anytime I want to. And that to me is really the icing on the cake as to why this makes the most sense as being the safest, most flexible way for older adults to finance and own real estate. Any questions on that? A few things to know as a realtor: this particular finance option does not allow any lender credits, any realtor credits, any seller paid closing costs. So just know that. Also know that if the contract does refer to or includes a home inspection, if it's subject to that, we have to basically get a copy of that, and it's a part of the underwriting process. As far as closing, our average within Fairway nationwide for purchases and refinances, our average closing time is 32 days from the date of application. We do have a 17-day rush purchase program. I have H for P there. That's just short for HECM for purchase. So we have a 17-day rush option. Just know that in the state of North Carolina, for whatever reason, we can't close in North Carolina sooner than 21 days from the date of the application. Closing costs for these are run higher than a traditional mortgage. They'll typically average somewhere between 3 and 5% of the purchase price. 2% of that upfront closing cost is the initial FHA mortgage insurance premium. And again, that's the biggest reason why these are higher than normal traditional mortgage loan closing costs. You can use this to purchase a new construction home. It does require any borrowers or anyone on the title to undergo a HUD counseling call prior to us being able to start processing of their application. This is a telephone appointment scheduled by the borrowers, typically lasts about 30 minutes. The primary reason for it is really for an independent third party to just assess the situation and determine, A, are the borrowers mentally competent? Do they understand a reverse mortgage, how it works, and why they think it's beneficial to them? And more importantly, is there any type of elder abuse situation going on? Is there somebody forcing them to do this against their will? These closings are not subject to TRID, so you're not going to have closing documents 3 days in advance of closing and all that. Generally speaking, we're usually getting closing documents on the old HUD ones, maybe the evening before, sometimes even the morning of the actual closing. So we usually have closings in the afternoon just to give the attorneys time to get all the documents in. You can use this with programs like Ribbon and so forth that, buy the home for the buyers and then contract with them and sell them back to them once their house is sold or whatever. It does work with that. And it is required, of course, that the buyers do establish residency in the property that within 60 days of closing. That's a mouthful, but kind of a quick overview. I'll shut up and see if there's any questions anybody has, anything that I might need to go into detail more on before we jump into some examples of how this might apply to you. Roll on, Melissa.
Roll on.
All right. Okay. So here's an example. Okay. And I suspect that probably most, if not all of you haven't been in a situation like this. Okay. You've got a couple that comes to you. They're coming to you as their realtor to help them find a home to buy. This particular case, they're 65. They want to be close to their children, their grandchildren, etc. That's really the primary, number one reason that boomers move. They just sold their home out of state. They've got $300,000 cash to work with. They really don't want to take any of their other assets to apply toward this home. So basically you're looking at a $300,000 cash customer, okay? And based on what they're looking for, there's nothing out there really that fits them, their needs and wants at $300,000. But you've got the perfect house for them that's listed at $395,000. Problem is they only have 300 and they emphatically do not want to have a mortgage payment. So this is how the power of a heckin' for purchase loan could work for them, okay? So at age 65, based on current interest rates and so forth, they would be able to get a loan, a net loan of approximately $189,000. That's their maximum principal limit, less closing costs. So they've got $189,000 of loan proceeds to apply toward the purchase of this $395,000 home. That means that they need to bring $206,000 down payment to closing. Now they have bought the house they wanted, and that's perfect for them. They have no monthly mortgage payment. Again, they do have to pay taxes, insurance, HOA fees. And they have $94,000 from their $300,000 left over that they can put in their nest egg, use however they want to use it. So think about what you've just done here. You've taken a $300,000 cash buyer, put them in a house that's basically a third more than what they thought they could afford to buy, $95,000 more than they thought they could buy, and you've allowed them to hold on to $94,000 of the cash from their prior home. I mean, that sounds like a win-win to me. Any questions about that example? Okay, let's move on to another, okay? This is a home, let's say you got a home listed, it's listed at $400,000. This is a 70-year-old widow. She's on fixed income and has basically $15,000 in savings. If you can get her 400, she'll net about 385 in this example, okay? She already knows where she wants to buy. She's got a house basically lined up. It's a new construction ranch, closer to family, $385,000. She, again, can't afford a monthly mortgage payment, doesn't want a monthly mortgage payment. So you're working with a deal where you're going to sell her house, net out exactly what she needs cash to buy the home that she wants. Problem is, the house is not selling. There's very little activity on the house. You're recommending that she drop the price $10,000 to see if we can't generate some interest and get this thing going. Problem is, if we drop the price 10, that's $10,000 that she's going to have to reach into her savings to get to buy the house that she really wants, leaving her with about $5,000 in her nest egg. And she doesn't really want to do that. Okay. And therefore balk. So you've now got a situation where things, you may be dealing with a little slow turn on her house. Obviously, that's not the case in today's market, as all of you are aware of. But let's take a look at how this may play out for her if we look at a heckin' for purchase option for her on this $385,000 home that she wants. Okay, so the heckin' for purchase would allow her net proceeds of $193,850. Okay, she borrows that, applies it to the purchase price, pays $181,150 from the proceeds from the sale of her house to buy the new home. Okay, obviously she was able to do that, give you yes to the go ahead to sell her home quicker. Okay, now she sold her home, she has the $375,000, and out of that she has the leftover funds based on what she had to put down, plus the $15,000 she already had. So she's now in the house she wanted, no monthly mortgage payment, no impact on her cash flow, and she's now got almost $210,000 in savings versus $15,000. Does that make sense?
It does.
I hate Zoom because I never know whether it's soaking in or not. But let's try a third example here, and this is it, and then we can open it up to questions and so forth. But here's a situation that is more of a list, an application where you could apply this option to get a listing. Okay, so you're working with the Smiths. Okay, they're 66 and 62. They're in a home that's basically worth $250,000. They really want something that what I would call right size. It's not so much the size of the home as much as it is they just really need a house that fits their retirement needs and lifestyle better than the one they're in. And you want that listing because that's a perfect starter home that you can sell tomorrow if you just had the listing on it. Okay. Mr. Smith's retired. Mrs. Smith plans to retire in 3 years. They don't want a mortgage payment. Again, I'm of the philosophy that, 15, 20, and 30-year mortgages were not designed for people retiring and obligating themselves to making mortgage payments in their 70s, 80s, and 90s. Okay. So, again, we're looking at $250,000 sale, $250,000 purchase. There's nothing in that $250,000 price range that has the features and everything that they want. That would be enough to warrant them to pull the trigger, sell their house, and go buy. Okay. Now there's a neighborhood that they love and they've talked with you about it, but the homes in there are $350,000. And basically they are at a point where they're saying, hey, we don't have additional funds we're going to put into it. We're not going to have a mortgage payment. We're kind of, there's nothing in our price range that we can buy that we like, so we're just going to stay put where we are. Okay. Anybody ever run into that? I'm sure you probably have. So if you understand again the power of using a HECM for purchase for borrowers over 62, at her age 62 and the current interest rate, which is today's about 2 1/3 on a HECM for purchase, okay, she would have about $160,000 of net loan proceeds to apply toward the purchase price of this $350,000 home. That means she brings about a down payment of $190,000. Okay, she buys a house with $190,000 from the sale of her current home, leaving her roughly leaving them roughly with about $40,000 of additional cash from that sale. They're now in the home that they wanted. They have no monthly mortgage payment, which they wanted. And you, as the realtor, got the listing on their $250,000 house. You got the sale, and the sale of that house potentially, and the sale of the $350,000 home. Again, I think that's a win-win-win. Hopefully these examples, real life examples, are giving you an idea of how this potentially can come into play. Fairway, by the way, just so you know, we are now the #1 lender in the country, reverse mortgage lender in the country for loans used to purchase homes. That's something that we work very, very hard on. It's a part of our focus, and we would love to be your realtor when you're working with some of these older buyers or sellers. I'm going to shut up, Melissa. We're going to open it up for questions if anyone has anything. And if not, maybe they'll get off to an early lunch.
Right. Does anybody have any questions?
Again, I will say this. I mean, this is a lot to swallow. I know it's a lot of information, and I'm sure probably maybe I've created more questions in your mind than answers at this point, which is not uncommon. It's not an easy product to kind of get your head around because it's so counterintuitive to how we've all been brought up to think about borrowing money and paying it back. But as I said at the beginning, I'm available, would love to meet with you one-on-one, either via phone call, over a cup of coffee, or whatever. Go into this in a little bit more detail, answer any specific questions you've got. this is a very much underutilized product, and I think it's a game changer, particularly if you're working with folks that are in this 62 or above age bracket.
Hey, Rudy, I've got
that offers out there anytime. Yeah, go ahead.
So on that last example with the Smiths, it looks like, if I had the numbers correct in my head, that it was 160,000 that they got from the HECM program. Is that correct?
Correct.
Okay,
Correct.
so
That's
tell
correct.
us, just kind of walk through what happens when the last person is leaving the home or passes away. What is the process for covering that loan amount?
Okay. So what happens? So let's just say in this particular case, they borrowed $160,000. They bought the house. They lived in it, whatever it might be, ever how many years you want to assume, and never made a payment. So basically, you've got a non-amortizing loan that's growing over time. Okay. So in the end, the last borrower is no longer in the house. They passed away or whatever. Okay. Once that condition has been has occurred, okay, the borrower, if they're still living, or their heirs, have 30 days to notify the lender that they're no longer occupying the house, and therefore, you know, the loan is going to be due and payable. Okay, they have a 30-day window to do that. Now, if the heirs assume that they want to sell the house, they have, or even the borrower, if they're still alive, but say in a home or whatever, have 12 months to sell it. You have basically an initial 6-month period to sell it, and then you can apply for 2 3-month extensions beyond that. So there's about a 13-month window to sell the home and pay off the loan. Now, obviously, the heirs could buy the house if it were a home that, you know, was a legacy property that they wanted to keep. They could do that, or they could sell it, obviously, pay off the loan, and then split the proceeds based on whatever the will and testament of the deceased borrowers was. If in the end, let's say the loan was more than the house is worth. Let's say the loan has now grown to, $350,000, and the value of the house is actually going down. It's less than $350 now. Let's say it's $300. So there's $50,000 more owed than what the house is worth. Understand this is non-recourse. So those heirs or the borrower, if they're living at the time, are not responsible for that $50,000. That's covered by the insurance. So let's just assume that it's the heirs that are inheriting at that point in time. They have 2 options. They can simply give the keys to the lender in lieu of foreclosure and walk away. Okay. Lender then sells the house, whatever they get, and FHA will make them whole in the end. The other option the heirs have is they can actually sell it for 95% of the appraised value at the time. And that will satisfy the loan, and FHA will make the lender whole. Does that make sense? Was that a clear answer, or have I got you more confused?
No, that gets me clear. I think what I think is a little confusing is just the interest over the period of a loan, the amortization of that, and that's what we really aren't discussing here. And I think that
exactly.
A buyer, that's going to be the real issue.
It is. I mean, it's always a concern with every borrower that I work with. I mean, one of the things that we do is we spend time looking at a projected amortization schedule, and we'll look at that based on whether they're planning to make payments or not. Most people just want to see it. What if I do this and I'll just, to maximize my cash flow and use it how I want to and never make a payment? And we make some assumptions. Okay, we assume an interest rate. The interest rate we assume is typically the 10-year average over the past 10 years of the index, plus whatever the lender margin is on top of that. That establishes what we call an expected rate. And in today's world, that's usually somewhere around 4%. Okay, we're looking back at the last 10 years and what seems to be kind of an average margin on these. Now, bear in mind that generally speaking, real estate appreciates, goes up in value and doesn't go down in value. And nationwide, the HUD default average property appreciation is 4%. So if you think about it, you know, if you're expecting a loan to grow at about 4%, and you're expecting a property to appreciate at 4%, you know, the equity that's there will basically just continue to be there on a percentage basis going forward. They're just kind of offsetting one another. Actually, it will actually, your equity will grow because 4% growth on the home value is going to be greater than 4% growth on a portion of the home value. That is the loan, correct?
Yeah, yeah.
Now, where all that could get, you know, a little bit awry would be if interest rates went up. Now, 98% of the loans that are originated with HECMs are adjustable rate, but they do have lifetime caps on them, typically a 5% life of loan cap. So you're looking at a maximum rate on most today at somewhere between 7 and 8%. Okay, so even if the rates was to maximize and stay there for an extended period of time, and let's say property appreciation maybe not be where we want to be, you know, or where we're projecting it to be, it's still going to take a long time to eat away that difference because, again, you've got growth on the loan amount that's a lower balance than the growth on the actual value of the house.
Mm-hmm.
FHA and HUD have kind of fine-tuned these things over the years to where, I mean, let's face it, FHA wants to protect that mortgage insurance pool. So the likelihood of somebody owing more than the house is worth today is pretty slim. Now, that's not necessarily true in the past, and you've probably maybe seen situations in the past where that was the actual case. In the end, there was more owed than the house is worth. And a lot of that has to do with the fact that years ago, you could borrow a higher percentage of the value of the property using the reverse mortgage.
Thank you, Rudy.
Does that help?
Yeah, I think it does. I think the question for me would come down to how to counsel and best advise, you know, a prospective client and make sure that I'm covering myself and not you know, overextending my knowledge.
Yeah. Well, David, you've hit the nail on the head. I mean, that's all of our challenges. That's the challenges for me. It's the challenges for my loan officers. It's the challenges for the financial advisors I work with, the realtors that I work with. You know, how do you position this? You know, and it's even more difficult in your world these days, particularly in the purchase environment, because good grief, I mean, that is. I mean, you can't get people to, you can't slow down at all. It's just like everything moving, it's, you know, as fast as possible. And to get somebody to slow down long enough to have a conversation about a finance option that might be in their best interest when they're trying to compete against who knows how many buyers to get a house, you know, that's tough. You know, what I usually tell my people here, the loan officers here who are looking, you know, at people and trying to, you know, we really have a best product, best fit type of mentality here, and they see people that this is the better product and the better fit for. I usually will tell them that there is another finance option designed specifically for older homeowners and buyers, you know, that might be a better fit for them. That gives them more control over their payment and cash flow, et cetera. And, you know, would they be interested in looking at it? I don't expect realtors and even my own loan officers to know all the ups and downs of reverse mortgages. But if you can kind of fashion a way that you can introduce this as an option without putting yourself, you know, against the wall and getting too far into the weeds with it, you know, I'll be happy to, you know, take the referral and be the one to try to educate them and show them in detail how this works. You know, the biggest thing from your perspective is, it may be an opportunity for older buyers to be able to buy the house they want versus the house that they feel like they have to settle for because they don't want a mortgage payment. B, it may be an option that will allow you to get listings on property where people were thinking that all they could buy was what they would get from the sale of their house, and there's nothing out there they want. So I think there's definitely some advantages there that this option could give you. The other thing is, I'm just not a proponent of putting all your cash into a house. I mean, if somebody comes to you and they've got plenty of cash to pay cash for the house, is that the best thing for them to do? Or would they be better off to take half that cash and put it toward the house and keep the other half in investments or whatever?
Mhm.
To me personally, I just think that's a better option.
I agree with you. Thank you.
Yeah. But, where this really makes the most sense is when you start looking at specific examples. So it might be one of those things where if you just had a situation, you just said, hey, Rudy, here's my situation. Here's my buyers. Here's their date of birth. This is how much cash they've got. How much house can they afford to buy based on what they're willing to put into it? I can help guide and direct you there, so you kind of have an idea of what the ceiling would be on purchase price and better know what you can go out and show them. The other option would be, hey, again, I've got these folks, here's their date of birth. They're looking to buy a house at X dollars. How much down payment are they going to need to get this if they use the HECM purchase option for financing? And when we start looking at some specific examples like that, and projected amortization schedules and so forth, it makes more sense, I think, than just general conversation like we had today. But I appreciate the question.
Anybody else have any questions or comments? Well, I appreciate.
I think thank you, Melissa, for the invitation. This is what I love to do, this kind of thing. So, if you ever need a follow-up, or if you just have a small group that wants to have a follow-up to learn more about it or whatever, reach out anytime. Would love to be that kind of resource.
I appreciate that. And I mean, I think this is just another avenue where as realtors, we can help our clients and find something that fits their needs. So I definitely appreciate the time, that you've taken to come back on here. I hate that it's been so long, but I mean, that's kind of how it's been lately.
Well, it's kind of, for me, as I'm getting older, I'm finding that the days are long and the years fly by,
Right.
My grandmother used to say that when I was a little fella, and I thought she was crazy, but I realize now that she probably knew more than I realized.
All becomes clear.
It does. But we really appreciate that. We, Fairway, really appreciate the opportunity to work with you folks. You've got a great organization. I know our LOs that you all work with love working with you all, and I'm just a part of that team. So whoever you work with now, continue to work with them. If you got a situation where my finance option with the HECM might make sense, they can pull me in, or you can pull me in, and we'll see if we can make it work. We're here to help. We
appreciate you guys. I mean, you guys are a wealth of information for us, and I know Terry Whitesell's always willing to jump in and help and offer his advice and everything else. So we truly appreciate it.
Well, thank you. Everybody have a great Labor Day weekend.
Yeah, you too. Thank you again.
My pleasure. Thanks, everybody.